Principles of Accounting, Chapter 10. In Chapter 10, we look at long-term liabilities. There are a variety of long-term liabilities. One of the ones we're going to talk about is bonds. So bonds are a way that corporations can finance big projects. Corporations, city governments, state governments, the federal government all issue bonds as a way to raise money for different projects, and for people can buy them as investments then. So bonds have a lower risk than stock because you're guaranteed interest and a return on a bond investment, where on stock you're not guaranteed interest and a return. So some investors prefer to buy stocks for those protections. So we have our bond issue date, and then the company makes regular interest payments over the life of the bond. Then when the bond is due, it pays out the bond in full. What amount the interest payment is based on the bond's par value. So the par value is also known as the face value of the bond. So par value times the interest rate times time. Very similar to the way that we calculate interest for a note receivable or a note payable. The advantages and disadvantages to bond financing. So advantages are that bonds do not affect owner control. Every person that you sell a stock to owns a percent of your company. So shareholders are part owners. Bonds are just an investment in your company. They don't own, so they don't get any ownership. Also, interest payments are tax deductible. So any interest expense we have is a tax deductible expense. Bonds also can increase our return on equity. Disadvantages of bonds are that they require continuous payments. So with stock, we would only have eventual payments if we paid dividends out. And we'll talk about stock more in Chapter 11. But bonds require the regular payment of interest and then the large payment out at the bond maturity. This is an example of what a bond might look like. So we buy a bond, it would be numbered. We would have one for every number that we owned. We would have our issuance date. There would be information about what the par amount of the bond, what the rate was, how it could be turned in. Bonds are also traded on the market. So they're securities that can be purchased and sold in the market. They have a market value. For here, we have IBM bonds that right now are at 103% is what they're called, 103.08% of face value, which means that it's 3.08% higher than the face value. Most bond pars are $100 to $1,000. They're usually a nice round number. When we issue bonds, that's called the bond issue date. So here we have a company issued bonds with a par value of $100,000 at an 8% interest rate. We're going to pay interest on June 30th and December 31st. The maturity date of these bonds is 2 years later. So first we issue the bonds. We collect cash of $100,000 and we create a bond payable of $100,000. On June 30th, we make our first semi-annual interest payment. So that's half a year of interest. Every 6 months until the bonds mature, we're going to pay interest out to the people who have purchased our bonds. When those bonds mature and we pay them back, we pay back the face value of the bonds. Bonds can be sold at their market rate, which is at their par value. So if the contract rate of a bond equals the market rate of the bond, that is the bond selling at par value. If the contract rate of the bond is lower than the market rate, it's called bond selling at a discount. And if the contract rate is higher than the market rate, that means a bond is selling at a premium. There are special accounting rules for bonds that have sold at a premium or a discount. We don't look at those in Principles of Accounting 1. If you take intermediate accounting, you'll learn those special accounting rules for bonds. Bonds can be retired. We can retire bonds early or at their maturity date. So here we've retired bonds at their maturity date. So it's just we pay them, they're no longer at our records. However, if we decide to retire them before their maturity date, we have this example here. If their current market value is greater than the retirement price, there's a gain. And if their carrying value is lower than the retirement price, there's a loss. So in this example, we have $100,000 of callable bonds. Callable bonds are bonds that the company can call back at any time before the maturity date. Companies might want to do this to avoid future interest payments. So if I have sold 20-year bonds and I'm paying interest for 20 years, and then one year we had a really good year, after about 15 years, I decide I want to pay those bonds off instead of paying 5 more years of interest. Then I would call back the bonds or retire the bonds and pay off all of my investors for the full amount. So here the bond carrying value is $104,500. So there is a premium on the bonds payable. We can also convert bonds to stock. So if we have convertible bonds, these bonds can be converted to a percentage of common stock. So here we have $100,000 in par value bonds with a carrying value of $100,000, and they can be converted to 15,000 shares of $2 par value common stock. Therefore, we would record 15,000 shares of stock, and then any additional amount is called the paid-in capital in excess of par value. Another long-term debt that we look at are different kinds of notes payable. So long-term note payable is when repayment of the note is longer than 1 year out. Okay? So we have a note payable, and when we're looking at long-term notes, we want to know when is the repayment of the principal and interest going to be made. Is it in a lump sum on the maturity date? So is a single payment of principals plus interest? So that's in this example. We have one single payment, we take the note out, and then on the maturity date, we pay a single payment of principal plus interest. Or we have regular payments of principal plus interest. So this is called an installment note, where we make installment payments on a regular date, either every month or quarterly or semi-annually. We would make regular payments of principal plus interest. So we have an example here where we pay an installment note. We borrow $60,000 from a bank to purchase equipment. We sign an 8% installment note requiring 3 annual payments of principal plus interest. So when we want to compute the periodic payment, here we're dividing the face amount of the note by the present value factor. What the present value factor is a table that gives us the present value of certain percentage amounts and lump sum or annuity payments. Annuity payments are payments that happen on a regular basis, where a lump sum is a one-time payment. So in this example, we're looking at an annuity of $1 for 3 years at 8% interest. So we have our present value of the note is $60,000. If we take it times the amount on our table of 2.5771, we get a yearly payment of $23,000, or our year one payment of $23,282. When we have an installment note, with equal payments, so in this example, we have 3 equal payments of $23,282. The first payment is higher interest than the later payments. So this happens with home mortgages too, and car payments, and other kinds of, call it annualized installment payments, where we pay more interest in the very beginning of the loan. And then as the loan gets closer and closer to payoff, our payments are more principal than they are interest. So we have our 3 payments of $23,282, which is the combination of our interest and our principal. Now we would have our journal entries. So our first payment is a cash payment of $23,282. Part of that is interest expense, and the rest is paying the principal of the note. We also have we look at our amortization schedule to make our second payment, which is also part interest expense and part to the balance of the note. So we would create an amortization table for any kind of these installment payments. This is a very popular way for, like I said, car payments and house payments to be paid. A mortgage note is a legal agreement that helps protect the lender if the borrower fails to make the required payment. So this gives the lender the right to be paid out of the cash proceeds from the sale of the borrower's assets, specifically identified in the mortgage contract. So in this example, we are securing our loan with an asset, some kind of property. And we're saying that if we fail to make the payments on this liability, that you can then take our property and collect any cash from selling that property. We have a wide variety of kinds of notes. We can have secured notes, which is an example of bonds and notes, which would be an example of like a mortgage bond or a mortgage note, where we secure that with an asset. They can be unsecured. They can be term and or serial. They can be convertible and callable, which we've talked about. So callable is when we can call it back early. And convertible is when it can be converted to stock from a bond. Whether a bond is term or serial depends on when its maturity date it is. So a term bond is going to have a single maturity date, where a serial bond might have different maturity dates where it can gain at different funds. An example of a serial bond would be like a U.S. savings bond, where it matures 25 days after, or 25 years after purchase, and then can only collect interest for so many years after that. So if you haven't cashed it in by 30 years, it doesn't just keep growing until you pay it off. A registered bond has its owner's name and contact information recorded on the bond, where a bearer bond doesn't record the owner's information. So bearer bonds are physical certificates, and so whoever has the certificate is considered the owner of the bond, regardless of whose name is on it. So bearer bonds, you want to be very sure that you don't lose because they don't have registered owners on file. The last thing that we talk about in Chapter 10 is the debt to equity ratio. And what the debt to equity ratio is how a company is financed, whether they are financed by debt or financed by equity. So do they have more liabilities or more stock? This helps us determine the risk of investing in a company. So we would divide its total liabilities by its total equity. And we see these different debt to equity amounts here. There are advantages, as we said, to financing with debt, which are bonds. So taking loans out or selling bonds in order to finance things. One of them is that we don't sell ownership in our company like we do with stock. However, there are also downsides to having too much debt. One of those downsides being that we have to be able to make our interest payments and our debt payments at the end of the term, where with equity financing, that's by selling stock, whether or not we pay out depends on whether or not we decide to issue dividends. As we'll talk about in Chapter 11, we're not legally required to have dividends for our shareholders. So this is Chapter 10, or this is what we're going to focus on in Chapter 10. As I talked about in class, there are a few other things in Chapter 10 with bond discounts and bond premiums. And we decided a couple of years ago to take out covering that portion of bond structure with Principles of Accounting students, and we focus on bond amortization and discounts in intermediate accounting instead.